Ladies and gentlemen, good day and welcome to CreditAccess Grameen Ltd Q4 FY25 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Renish from ICICI Securities. Thank you, and over to you, sir.
Yeah, thank you, Sagar. Good evening, everyone, and welcome to CreditAccess Grameen's Q4 FY25 earnings call. On behalf of ICICI Securities, I would like to thank CreditAccess Grameen's management team for giving us the opportunity to host this call. Today, we have with us the entire top management team of CreditAccess Grameen, represented by Mr. Uday Kumar Heber, Managing Director, Mr. Ganesh Narayan, Chief Executive Officer, Mr. Nilesh Dalvi, Chief Finance Officer, and Mr. Saib Sharma, DGM Investor Relations. I would like to hand over call to Mr. Uday Kumar for his opening remarks, and then we'll open the floor for Q&A. Over to you, sir.
Thank you, Rinesh. Good evening to all. We are pleased to welcome you to the conference call to discuss our fourth quarter and FY25 business performance. This year has been transformative for the microfinance industry, defined by the stimulus unfolding of diverse internal and external challenges. The microfinance industry has been tested by a complex set of challenges, including extreme heat waves, operational limitations due to prolonged elections, growing customer over-leveraging, ring-leader issues, tighter underwriting resulting in multiple MFIN guardrails, and temporary disruption stemming from the Karnataka ordinance targeting unregulated lending practices. The rising delinquency trend in the microfinance industry, which began in April 24, peaked in November 24, subsequently reversing till March 25. We are already witnessing new PAR accretion rate largely getting normalized across all states, excluding Karnataka, whereas we expect the new PAR accretion rate in Karnataka to normalize by end of Q1 FY26. Through every challenge, CA Grameen has emerged stronger, proving the resilience and sustainability of the model that we have created. We witnessed a declining new PAR accretion rate across all states, while elevated delinquencies in Karnataka during Q4 FY25. In all states, the turnover story has been continuing since November second half, driven by reduced leveraging, improved ground level situation, high customer connectivity, expansion of our employee base enabling more frequent and disciplined follow-up. Combined with targeted support from our business support team, this strategy delivered stronger recovery outcomes across delinquent accounts. We observed encouraging traction of collections from PAR buckets, with 40% of our customers in PAR 1 to 60 and 10% of borrowers in PAR 60 plus making partial payments. As guided, we strengthened our employee strength from 19,333 in December 24 to 20,970 by end of March 25. Importantly, we maintained a firm grip on employee retention, achieving an annualized attrition rate of 30.5% in Q4 FY25, amid high churn across industry. The revised FY25 growth guidance of 7 to 8% issued in January 25 was impacted by incremental stress emerging from Karnataka. This stress became visible from the last week of January 2025 because of operational ambiguities in anticipation of the ordinance, on-ground hostile environment, media and political sensitivities, and collection being limited to center meetings. It is important to highlight the role of MFIN in serving as a unified voice of the microfinance sector in such a situation. They proactively engage with the Government of Karnataka, the RBI, and the stakeholders, demonstrating the sector's commitment to strong governance, customer protection, and regulatory compliance. Their leadership ensured that the ordinance focused on addressing unregulated entities with minimal impact on the legitimate operations of regulated institutions. Despite these challenges, majority of borrowers continue to repay, reflecting underlying customer resilience. However, disbursement momentum was affected as we prioritized our focus on portfolio stability over guided growth, with disbursement rate dropping to 57% in February and 65% in March as a proportion to the normal rate. While these factors altered the Q4 FY25 growth plans, They were necessary to navigate the evolving environment and to protect our portfolio quality. As a result, our growth, credit cost, and profitability parameters are not in line with the revised guidance. We added 2.61 lakh borrowers in Q4 FY25, of which 43% were new to credit, resulting in FY25 new borrower addition count at 7.49 lakhs. The new to credit percentage trend has increased from 30 to 35% to 40 to 43% level over the past couple of quarters, demonstrating the underlying potential of the microfinance business across the country. As a result, our unique borrower count has increased from 26.3% in August 24 to 31.1% at the end of March 25. We opened 100 branches during the year across well-established markets and newer geographies. Our Evolve with Customer strategy is helping deepen our customer engagement, with retail finance reaching 1,543 crore, contributing 5.9% of the AUM compared to 2.7% a year ago. MFIN guardrails, coupled with our internal policies, including three-lender cap implemented in Karnataka from February 25 itself, we have achieved significant deleveraging over the past 7 months. The GLP of borrowers with more than 3 lenders declined from 25.3% in August 24 to 14.7% in March 25. And the GLP of borrowers with over 2 lakh unsecured indebtedness declined from 19.1% in August 24 to 10.8% in March 25. Further, the average total unsecured debt of CA Grameen borrowers has declined 14% YOY, while average monthly obligations have declined by 10% YOY. Now, I'm referring to a slide 12. It is important to see PAR 15 both at the company level and excluding Karnataka. In case of borrowers with 4 lenders, PAR 15 excluding Karnataka remained same at 11.7% QOQ. Similarly, PAR 15 in case of borrowers with more than 4 lenders excluding Karnataka stood 27% in Q4 FY25 versus 26.1% in Q3 FY25. Out of the overall PAR 15 of 6.6%, 41% of the account of borrowers with more than 3 lenders. Our accelerated write-offs initiated in Q3 FY25 alongside a prudent provisioning strategy have advanced the cleanup of stressed exposure within the book. We have taken rupees 479 crore accelerated write-off in FY25 of non-paying loan accounts with 180 plus DPD, resulting in additional credit cost of 151 crores. The total write-off of FY25 stood at 1,124 crore. Overall, the company continued to hold 179 bips, about to 456 crore higher provision over PAR 90, 370 bips or 915 crores higher provision compared to IRAC prudential norms, and rupees 98 crores higher provision compared to NBFC provisioning norms. The credit cost stood at 583 crore for Q4 FY25 and 1,929 crore or 7.7% for FY25. The deviation in the credit cost compared to the revised guidance was primarily due to the Karnataka issue. Our collection efficiency excluding areas stood at 91.9% for Q4 FY25, while being 92.4% for the month of March 25. PAR 90 plus stood at 3.28%, GNPA of 4.76%, and NNPA at 1.73%, both predominantly measured at 60 plus DPD. The net interest income grew 1.7% QOQ to rupees 876 crores, with portfolio yield at 20.4% and interest spread of 10.3%. Our average cost of borrowing has remained stable at 9.8% for the last 7 quarters. In Q4 FY25, we raised rupees 3,144 crore, including USD 50 million through ECB route from International Finance Corporation. The share of foreign borrowings stood at 21% at the end of FY25, firmly moving towards FY28 medium-term strategy of sourcing 25 to 30% of fund from foreign source. NIM remained healthy at 12.7% for Q4 FY25, while 12.9% for FY25, in line with our revised guidance. Cost to income ratio was at 31.9%, while PPOP stood at rupees 634 in Q4 FY25, 2,638 crores in FY25. Our accelerated write-off approach has certainly impacted Q4 FY25 profit, which stood at rupees 47 crores, though it will help safeguard our profitability going ahead. The liquidity levels, including cash and cash equivalents, remain adequate at 2,336 crore, amounting to 8.4% of total assets. Additionally, we have sanction in hand of rupees 3,689 crore and another 4,667 crore worth sanctions in pipeline. The capital adequacy remained comfortable at 25.5%. Amid multiple headwinds faced in FY25, we delivered ROE of 1.9% and ROE of 7.1%. Our cross-cycle performance of ROA of 3.6% and ROE of 14.4% over past 8 years is a testament to disciplined execution and consistent value creation. We are well poised for FY26 on the back of stabilizing asset quality and improving business momentum. As we look ahead in FY26, we must carefully balance both asset quality normalization as well as business growth. With a more balanced competitive intensity in the industry supported by MFIN guardrails, we see good opportunity to leverage our strong balance sheet and capital position to drive business growth. Our retail finance division will prove to be strong growth accelerator going forward. However, we also need to be cognizant of various industry challenges in the form of higher steady-state delinquencies, managing the productivity of loan officers, reduced credit supply for microfinance customers, and temporary impact of any potential state government regulations in lines of Karnataka. Considering the evolving business environment, we are aiming for AUM growth of 14 to 18%, of which MFI growth will be 8 to 12%, and balance will come from retail finance. NIM of 12.6 to 12.8%, credit cost of 5.5 to 6%, ROE of 2.9 to 3.4%, and ROE of 9.8 to 13.3% in FY26. Before I hand over the forum for the Q&A session, I would like to inform you all that I shall be retiring from my role of Managing Director on 25th June 2025. With effect on 26th June 2025, I shall be appointed as non-executive nominee director, subject to necessary approval from applicable authorities and shareholders. I shall also be appointed to the Managing Board of CreditAccess India BV, the holdco, to support the group. Further, our CEO, Mr. Ganesh Narayanan, shall be appointed as Managing Director and CEO for a period of 5 years with effect from 26 June 2025, subject to necessary approval from the Reserve Bank of India as well as shareholders of the company. We look forward to your continued support as we take our company into the next higher orbits of the growth. Thank you for your patience.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star then 1 on their touchtone phone. If you wish to remove yourself from the question queue, you may press star then 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Again, to register for a question, please press star then 1. Our first question comes from the line of Rajiv Mehta from Yes Securities. Please go ahead.
Sir, hi, good evening. Just a couple of things. Sir, when I look at the ECL coverage, I think they seems to have come down across stage 1, 2, and 3 assets in this quarter versus previous quarter. So if you can just throw some light about, has there been any revision in the ECL model, and then what levels of ECL coverage has been carried forward in the guidance of credit cost that we have given. Second is on when I look at, say, even excluding Karnataka, when I look at the other geographies and when I look at their PAR accretion, monthly PAR 15, accretion rates, they are still 20-30 bips above, say exactly 1 year back in March and April. So when we give out a guidance of a certain credit cost, while you've broken up the guidance of credit cost, are we factoring that this 20-30 bips of slightly above normal accretion trend to further normalize, or you have taken that this will be the new normal in the credit cost?
Thank you, Rajiv. In the case of ECL coverage, there is a minute change where in the stage 3 borrowers who are paying more than 50% of the EMIs, we have taken a little lower credit cost based on our earlier experiences. So therefore, you could see about 2% variation in the total ECL coverage. However, this coverage is based on 60-day DPD, not 90-day DPD. Therefore, there is no large variation. That is one on the ECL coverage. Second, on other geographies, largely it is back to...
Even the ECL coverage of stage 1 and stage 2 assets has come down.
Rajiv, Nilesh here. So on stage 3, as Uday said, obviously on the partial paying customers, we have taken a lower ECL in line with the approach we had taken even in the earlier times. In stage 2, you see the ECL, it has come down because in stage 2, there is a higher proportion of delinquency from Karnataka. And Karnataka historically has a higher number of low risk and medium risk districts. So that's where, as you know, that our ECL percentages vary. This is the district level risk profile. So that's where the stage 2 percentage has come down because it has a higher proportion of Karnataka.
The low risk customers and low risk geography, that is where the fall variation, because we do the district level coverage, the high risk, high delinquency come in the low risk where the actual ECL is slightly lower compared to others. That's what the change. On the other geographies, what we said is largely come back to normalcy. However, if you see when we give the guidance, we can see the slide where the guidance is mentioned. We took 3 to 3.5% for the normal for this financial year, which actually captures the slightly elevated for this financial year. So we captured that slightly higher for this financial year. Therefore, it's already captured within the guidance what we made. I think I captured that both.
And sir, there is a mention in the slide that you are seeing improvement in center meeting attendance. So if you can just throw some light on what kind of an improvement that you are seeing in terms of maybe percentage of attendance in the meeting. And the employee addition which we have done in Q4. So if you can highlight in which functions, where are these employees added and in which geography?
Yeah, largely employees are added in particularly Tamil Nadu. We had little higher attrition compared to earlier during Q3. So higher employees added in Tamil Nadu. Whereas other geographies are fairly common because we didn't have any large attrition in any other states. So therefore, it's a normal attrition. We try to put little extra employees in all the places. If you see, we have almost 8% extra we have built in actually in all places. Therefore, which will help us to monitor more and then have a higher connectivity and to have a higher follow-ups also, which will have a benefit in the coming quarters. And in case of center attendance, largely it's improved in all geography, including the geography like Bihar, UP, Jharkhand, Orissa. Also, we are seeing good improvement and on the people coming back to center meetings, and the payment in center is increasing actually. So we have seen visible improvement in all geographies.
Okay, sir. Thank you so much.
Thank you.
Thank you. Our next question comes from the line of Shreya Shivani from CLSA. Please go ahead.
Yeah, hi. Thank you for the opportunity. You have highlighted in your presentation about the focus on retail finance segment as well. I wanted to understand the ticket sizes in this segment have reached a certain level and they've been range bound for the past 4 quarters. What is our outlook on how the retail finance segment's ticket sizes could move? Also, during this entire last couple of months challenges, how has the retail finance books asset quality behavior been or customer behavior been? If you can highlight these two things. Thank you.
Okay. Sure. On retail finance side, the average ticket size for our unsecured business loan is around 1.7 lakhs, and we believe that will be range bound. And secured business loan, the average ticket size has been around 5.8 lakhs, and that will also remain in this range. 5.5 to 6 lakhs is our model, and we should remain in that range. And yeah, home loans, average ticket size is around 6.8 lakhs, and that's where it will remain.
Sure. So, and sir,
Part 0 is less than 2%. Part 30 is around 1.5, 1.9%. And with respect to secured business loans, Part 30 is around 0.89. And home loans, it's a new book, so it's almost nil.
correct, got it. And so this segment, all of
Did
these.
I answer your question?
Yes, you did. Just one follow up over here. Hello.
I think we lost.
Hello. Hello. Hello.
I think the starting
Yes,
itself
ma'am.
is.
We are able to hear you.
Oh, is it?
It's gone out.
Management, are you able to hear us?
Yeah, I can hear you.
Yeah, I was LinkedIn. It's actually more
Alright,
from
just give me one moment, ma'am.
what is in one.
Ladies and gentlemen, the line for the management seems to have disconnected. Please stay connected while we reconnect the management. Thank you. Ladies and gentlemen, we have the line for the management reconnected. Please go ahead, sir.
Yeah. So sorry, we got disconnected. So I'll repeat what I said. So on our unsecured business loans, the current average ticket size is around 1.7 lakhs. We believe it will be range bound around this number. And the Part 30 in this book is now 1.97. It moved from around 1% to 1.97, predominantly because of Karnataka effect. And in secured business loan, the average ticket size is around 5.8 lakhs, and Part 30 is around 0.89. And in home loans, the average ticket size is around 6.8 lakhs. And since it's a new book with around 100 crores, 110 crores AUM, there's almost nil par. I hope I answered your question.
Yes, sir, you did. Just one follow-up on this. So, I do. So, you've always mentioned that retail finance is one segment. You're scaling up more in your lower risk districts, which will be more Karnataka and Tamil and Maharashtra, Tamil Nadu, etc. But as of now, how much scope are you seeing for this business to be able to scale it up in any of your other geographies? Is there any comfort you're seeing in any other geographies, or should we just consider that it will continue in Karnataka and the lower?
So what we had commented upon is that we will launch these businesses in our higher penetrated geographies, because there's a certain amount of customer base. The model revolves around evolving with the customer, right? So from that perspective, the book is now in Karnataka, Maharashtra, Tamil Nadu, and Madhya Pradesh. During the year, we would probably look at a few more districts and states where we have higher presence.
Got it.
For example, the unsecured business loan is roughly in around 730 branches out of the 2,063 branches. So this will scale up slightly. With every moving year, we'll scale this up. All these products will move to newer states.
Got it. This is very useful. Thank you and all the best.
Thank you.
Thank you. Next question comes from the line of Shweta from Elara. Please go ahead.
Thank you, sir, for the opportunity. So, a couple of questions. So, I was looking at Bihar geography slide, and be it GLP or borrower base, that has declined significantly in Bihar. Even the branch network has remained steady state. PAR numbers and all are function of base, but we are of the understanding that it's the over-leveraged borrower base that had caused mess in Bihar. Is there anything more to read that is bothering you, wherein you are sort of declining your further penetration into Bihar? That's question number one. Second, can you provide some color on the borrowers with over 3 lenders accounting for 41% of overall PAR 15, as in from the regional geographic perspective or from the segment perspective? Third observation is the marginal cost of borrowings have spiked quarter on quarter. In fact, where we started off 9.3, now it's 9.6. So how do you see this? Because you mentioned about liability mix being slightly nimble in your opening remarks. So from that perspective, how are you perceiving marginal COB? Thank you.
Shweta, thank you for your question. So marginal cost is basically what we borrowed during the quarter. So there we borrowed significantly from the international fund, for particularly IFC. Therefore, average cost of marginal cost for the quarter was little higher than compared to the earlier borrowings. But still it is lesser than the average cost of borrowing. Average cost of borrowing is 9.8%. Marginal cost is the borrowing what we made in Q4 is at 9.6%. Still, it won't impact the overall cost of borrowing. There's a one large borrowing we did from international market, that's why it's slightly higher. Therefore, average was little higher. Second question is about Bihar. Yes, Bihar portfolio has come down to some extent because we took a strong steps during September to March, kind of September to basically January to handle with care, to protect the portfolio, higher management there, higher overview from a risk audit and control side. So with which, and then also the retention team. So I think those steps actually we try to protect portfolio, protect quality instead of growing during that period. Therefore, there is a slight decrease in the what you call total GLP. The reduction of customer is basically because of rate off, which the accelerated rate off majority part comes from that geography. Therefore, the number of customers came down. But we already started growing. I think in the months of February, March, we started scaling up with the new controls, additional controls with little lower ticket size, and then we implemented the new customer controls quite ahead of time before even everything got right. I think it is growing well now, and we are not withdrawing or reducing anything. We'll continue to grow and penetrate there, but with the higher controls and systems. So we don't see any challenges. Things are better now.
There's one point on Bihar. Bihar, temporarily, we also had certain people challenges. We had manpower shortage. That has also been corrected now.
Yeah.
And that is why you will see the reversal in Bihar is quite strong.
Reversing trend of delinquency is quite strong, quite fast. So we are quite fine there now. And the other one is of the borrower with more than 3 lenders in the under PAR 15, right? So it is 41% of PAR 15. This is a very insignificant number. It's not very high actually, but it's coming down slowly. But we see that's the risk. That's why we already provided that. Which state which is high, I don't know. Maybe largely in the northern belt. You have any data in that?
Yeah. So Shweta, largely it will like what we have shared earlier. We have a higher proportion of unique borrowers in our core markets, and obviously in the newer markets wherein we have entered over last 2 to 3 years, there is the proportion of borrowers having having 2 or 3 or 4 lenders. That proportion is obviously relatively higher there compared to our core market. So since you are referring to Bihar, yes, in Bihar, larger number of customers will fall within the 0 to 4 year vintage, and that is where those borrowers, in case they are having more than 3 lenders, there the PAR contribution will be more. So overall PAR in Bihar, if you see, it is 12%. Then obviously at a company level, if the more than 3 lenders is accounting for say 40%, then in Bihar it will be slightly higher. But overall, it's more of a broad-based, depending upon the vintage and the overlap what we have across different states.
Got it. Very helpful.
2.5% of overall customers. So to be clear, Shweta, this set of customers is about 2.5% of the overall customers of the company. So it's not so.
Yeah, the purpose of that data point, Shweta, was to highlight that not the entire issue is not because of over-leveraging. So the point was that 40% of the PAR is because of over-leveraging, but the balance 60% PAR is because of the business as usual factors, in addition to various other factors what we witnessed over last 12 months in form of income variations or heat waves, migrations, ringleader issues, etc. So various factors have been playing out in addition to over-leveraging. That's the point we wanted.
Thank you. Thank you for elaboration and best of luck.
Thank you. Our next question comes from the line of Abhijit Tibrewal from Motilal Oswal. Please go ahead.
Yeah, good evening, sir. Thank you for taking my question. So first thing, just trying to understand, in our FY26 guidance, we spoke about this 8 to 12% kind of growth in the group lending business, the JLG business. And you've also highlighted this is because of some accelerated write-offs which are expected in 1H. Just trying to understand why this year the growth is low. What rate can we start seeing the group lending business growing maybe from FY27 onwards? So asking this because, I mean, we understand what the industry has gone through. And to that extent now, I mean, after some of this stress from over-leveraging is behind, then at what rate can the industry be growing, and within that, what could our growth look like in the group lending business?
Abhijit, hi, Nilesh here. So, see the guidance what we have given for next year in group lending, which is 8 to 12%. So obviously it will be some extent there will be an impact of write-offs what we will be taking. And if you see when we had given a guidance in month of Jan, at that time we were anticipating that we'll be doing the cleanup by say end of June. However, because of the Karnataka issue, maybe it will get extended by another quarter and it will go to September. So predominantly whatever write-off which will happen in next financial year, the larger portion of that will happen in first half. That is where you will see the overall growth will be little flattish in the first half, X of write-off, and obviously we will cover it up in the second half wherein the write-offs will be more of normative in nature. From the growth perspective, obviously the customer additions, renewals, everything will happen. But yes, because of the write-off, you will see a flattish growth in group lending business in the first half, and it will catch up in the third and fourth quarter.
Got it.
So largely on a steady state basis, Abhijit, as we had said earlier, microfinance 14 to 15% growth on a steady state basis is what we will always look for. And including retail finance, it will go to 18-20%. Next year, that 14-15 is little lesser because as we come out of the current crisis and obviously the impact of write-off.
Got it. This is useful. And then the second question that I had was, I joined a little late. Have we already covered what we are seeing in Tamil Nadu after the introduction of the bill? Now why I ask this is very often we try to understand that, I mean, what we saw in Karnataka, we saw some bit of it brewing, right, in media, whether we talk about some news flow around suicides in Karnataka and then the Karnataka ordinance. But I think, I mean, from what I gathered by speaking to a few other MFIs, is also the fact that no one saw this Tamil Nadu bill coming, while everyone acknowledges it is not really applicable to regulated entities or MFIs for that matter. So the related question is what is happening in Tamil Nadu today? What is it that you are seeing? And the other thing is, are there any other states except, let's say, Karnataka or Tamil Nadu, where there are some problems today and going forward, there could be some such ordinances or bills which could get passed?
In Tamil Nadu today, ground level, there is absolutely no change or no impact as on date, right? However, we would be mindful, probably we would be proactive to engage with customers better. But at ground, there's absolutely no impact at this point in time. And with respect to if it's going to come in any other state, I think we'll have to kind of, from our perspective, we don't see anything as a signal or sign anywhere at this point of time. But we'll have to wait and watch.
Got it.
Yeah.
So then the noise is there. And there's more noise, but you're not seeing any impact on your collection efficiencies or power accretion just yet.
Absolutely nothing. We've not heard this from anybody else also. Not necessarily just us.
Got it, sir. And then, sir, the last question I had is, obviously, we can't control what happens in specific states, right? But, I mean, this whole mini credit cycle, so as to say, that we went through this year, whether we call it because of over-leveraging, heat waves, right? Maybe Tamil Nadu, some unseasonal flooding, cyclones. Is at least that part, excluding what is happening in specific states, at least that stress, is it now at least at the fag end, or is it now behind us as we move into the next year?
See, that's how it looks like for us, and hence we are saying that probably we would have a good second half, right? And we've also had good monsoons. There is no other signs at this point of time which is kind of worrying us or which is going to stress us apart from coming out of Karnataka at this point of time.
Got it, sir. This is useful. That's all from my side, and I wish you and your team the very best.
Thank you.
Thank you. Our next question comes from the line of Nidesh Jain from Investec. Please go ahead.
Thanks for the opportunity, sir. First question is on the credit cost. What I gather is that on a steady state basis also we are seeing that the credit cost of the business will be higher than what we were anticipating before this crisis. So how are we planning in terms of yields, margins to negate the impact of higher credit costs in future, let's say in FY27 and beyond?
I think, what we envisaged earlier also, in May 24, that there could be higher elevated. But for the next factor, we assume that it will be about 3 to 3.5% for the financial year, which is a normal credit cost for the year. That's what we are expecting. We need to review later after the year end, maybe 3-4 quarters down, we will review for the future years. And our district-based pricing and district-based what you call the ECL modeling will help us to have a reasonable moderation of yields, which will not have a too much negative impact to us. Because if the credit cost goes up in a district, our price also will go up to some extent. So therefore, it will not impact on the yield. That is why our guidance, NIM and yield are not actually different. It remains same. Impact is only to the extent of the reversal because of delinquency. Otherwise, it will remain same. So therefore, we are not seeing too much impact of the pricing or our credit cost will impact on our yields.
So I'm asking that in case the credit cost remains elevated at 3%, 3.5%, so whether there will be a yield increase on the new loans that you will be disbursing because the risk has increased.
Right. Already provided. It will not be on the every loan. Based on the risk, higher risk, we would actually increase the price. Or if there is a lower risk district, we may reduce the price also, right?
Also, the pricing model has a slightly longer tenor. Right? So it has to run through the tenor to show the impact in pricing. So we may not react immediately, but we'll have to see the time period in our pricing policy, how the pricing moves, and if there is anything that will be slowly passed.
Correct. Also, there is other impacts in terms of the cost of borrowing impact is there. That's also a declining trend is there. I think reasonably we'll be able to manage a decent, stable NIM and yields.
Sure, sure. And secondly, can you share the retail finance breakup in terms of secured and unsecured?
So the unsecured AUM is 1,100 and odd crores, and the secured business lending is 250. Okay. So the overall mortgage book is 350. Secured business lending is around 240 crores, and home loans is around 110 crores.
Sure.
Total 1,543 crores.
Sure, sure. And just last question is that, so we have shared a lot of data on customer leverage, etc. But if we include other retail loans for our customer base, what percentage of our customers will have other retail loans other than microfinance and unsecured loans?
So the overall, if I remember right, the overall retail bureau imprint is around 40% plus. But majority of that has consistently remained for years in gold loan. The rest of them are single-digit numbers.
Okay, sure. Sure. Thank you. That's it from my side. Thank you, sir.
Thank you. Our next question comes from the line of Chinmay Nema from Prescient Capital. Please go ahead.
Good evening, sir. Hope I'm audible.
Yeah.
Sir, firstly, a slightly longer-term question. Given that the stress now seems to be subsiding, how do you see or when do you see the PAR numbers basically reversing back to the normal levels, as in the Q1 levels or what they were back in Q4 last year?
See, I think whatever the PAR is created, it has to take its journey. So that's why we've said we will have probably a normative period in H2. So H1 will remain elevated. H2 should start coming back to normalcy.
Got it. And secondly, if wanted to confirm, if I understood correctly, basically the provisioning has come down during the quarter, basically because you're expecting better recoveries in Karnataka. Is that understanding correct?
No. Two aspects. Two aspects in this. One, because the PAR in Karnataka has gone up. Karnataka traditionally had a lot of lower risk districts. So hence the weightage has fallen, right? So there is a reduction there. And second, in stage 3, like Uday said, if customers are paying more than 50%, we have assumed a slightly lower credit cost because this is current repayments coming into the system.
And also the new PAR accretion has come down comparatively compared to Q3. So that also an impact which reduced the overall provision, new provision.
Understood, sir. Got it. Thank you.
Thank you. Next question comes from the line of Shripal Doshi from Equirius. Please go ahead.
Hi, sir. Thank you for giving me the opportunity. My question was on, firstly, by when do we see this more than 3 lender and more than 2 lakh ticket size customers, which currently stands at closer to 20.1% and 9.5%, dropping to our expected level? That's the first question, sir. Or our targeted level, rather.
So, it's difficult to have a targeted level here because it's all short-term loan. If you see in 7 months, there is almost 10% reduction. So it will actually go on as the MFIN guardrails will continue to be there. So it will automatically come down on a normal phase as they come back to regularize the loan with the payback and close their loan, automatically comes down. So overall, it's already coming down. The journey has begun, going on well. Maybe 2-3 quarters, it will come down to an accepted level for not only for us, for the whole industry also. It's just the industry targeted measures to deleverage the customers. No? I think it's already working well and it will continue to work well.
Okay. So second question was, like, we've given a guidance of 5.5 to 6% credit cost for 26, but I mean that doesn't have any buffer for any uncertainties that might come up in the state of Tamil Nadu from the ordinance that has come up. So just do you think there could be variation if something of that nature comes up? And if you think so, then should we not already provide that buffer in the guidance?
See, the ordinance, the talk about the ordinance has been there for the last 1 month almost. And we are not seeing any impact in the ground either to us or anybody else. So therefore, we are not anticipating anything coming practically from Tamil Nadu. So there is always a comparison of Karnataka to Tamil Nadu. Maybe I will take 1 minute to explain why this difference. In Karnataka, what happened? There was a heightened media, police, political intervention, everything before the ordinance, and that led to ordinance. There was a hostile situation for a month actually. By that time, the delinquency was elevated, and the ordinance came later, then with the clarity. So then slowly it came down. Whereas in Tamil Nadu, there is no such situation at all. It is government on its own maybe followed the Karnataka model and tried to implement by excluding upfront the REs and the banks. So therefore, we are not seeing any such heightened delinquency trend coming up there. So therefore, we are not believing that at this point of time, after witnessing almost 20 days of journey, we are not seeing any such events happening there. So of course, for a small variation here and there, it is we will be able to manage, because that is why we said that current regular credit cost may be slightly higher, which is 3 to 3.5, which should cover this kind of very small event. If a larger event, definitely the thing will change. So this is subject to reasonable stable period.
Got it, sir. Got it. This is just one last question. It's more structural in nature. So what are the changes that you see? Every credit cycle so far has taught us something at industry level and also at organization level, right? So this time around, what are the changes that you see are emerging, maybe on, let's say, credit underwriting side, even on tenure structuring side, or even on the collection frequency side? So, I mean, such as, say, maybe having credit manager at branch level. Do you see such changes or such operational changes being brought in by players in the industry?
Yeah, I think broadly, every such cycle takes you back to basics, right? So I think the fundamentals of microfinance is still intact, and we need to work on strengthening process. There was a gap in regulation for different kind of players that has also been kind of removed now. And the industry is working together in this challenge. So that's a very big positive thing in my view. And whatever steps we've taken, we are seeing it play out. And we are also seeing that people are mindful of expansion, people are mindful of underwriting, people are taking significant steps towards better income assessment. So I think the fundamentals of lending will have to play in a significant part also in microfinance as we move forward. And with strong bureau data over the period of years, and like I said, since the industry is now working together under SROs, we can navigate this better and probably have better environment as we move forward. This is what comes to my mind. What do you want to add?
I think it's a joint effort by the industry, by regulator, and by the SROs. Actually, I think all of them are working closely to see how to navigate going forward. The guardrails are one of the outcome. When I say guardrail, it's guardrail made by the industry itself. When you say MFIN, it is industry made the guardrail. That means the members are part of making that guardrail for themselves, right? So I think there is that kind of consciousness already there. Not only the guardrails, and again, underwriting systems. Many of them are probably improving the underwriting. Even our case also. For example, we expanded our audit team to audit the branch at a frequency of even less than 45 days today. So which is which very hard actually. So we have taken that kind of journey, and then to make it more strong, we implemented the business rule engine to accommodate the stronger control, stringent inflow of customers checks. So many measures are adopted. I think similarly, many MFIs definitely would have made that. I think it's a joint effort of all stakeholders together, and it is happening. I think these learnings are definitely will be helpful for the future.
Got it, sir. So thank you so much for answering my questions. I'll come in the queue if I have more questions.
Thank you.
Thank you. Next question comes from the line of Viral Shah from IIFL Capital. Please go ahead.
Yeah, hi, sir. Thank you. Sir, two questions. One is I look at slide number 13 and I look at the state-wise PAR. So when I look at Tamil Nadu, over there I see that for PAR 0, it has declined by around 80 basis points quarter on quarter, whereas the PAR 90 has actually gone up by 130 basis points. And if I say just do a flow analysis of the flow-through rates, it seems that the flow-through rate seems to be much higher in Tamil Nadu, say compared to even something like a Bihar. Is there anything to read over here, or what is it?
Difficult to read because Tamil Nadu, the higher delinquency happened in January, which moved into the bucket. So whereas December actually that moved in, whereas others from November the trend reversal started early, little 1 month early. Maybe that March is in between. Probably that made little difference. Otherwise, by and large, the trend is that is common across the geography. Because Tamil Nadu, we faced little bad situation because of rains and everything in December. Right? That all moved into PAR 90 in March 31st. There are some staff attrition issue also there along with that, which all corrected. So maybe it's an accounting issue, right? We are not seeing any very different issue in Tamil Nadu.
Okay, sir. So my second question is, when we talk of, say, near to normalized PAR accretion, say even X of Karnataka, if you look at, say, in the month of April, it is still more than double of what it was last year. So, like, is it something that we should be calling or talking of, say, close to normalization? Because this is going to be a longer journey, right?
Yeah, I think we said that near normal is correct because April was a little aberration in the first half of the month due to a lot of holidays, lot of festivals, lot of employee holidays during that period. So little aberration, but it's already coming back to normalcy in the May itself already. So it's a temporary blip of first 15 days of April. Otherwise, we are already back into normalcy.
Sir, but if I recall, like last year in the first quarter when the trends had started deteriorating, the explanation was, even from an industry perspective, that there were heat waves and elections. So I would think that even in the base, it would have already been there.
No, I think, let's compare to March. No, April, we know that there is a small blip. It's a temporary. We are aware why it happened because of holidays and festivals and a couple of, when there is a lot long employee holidays also there, employee transfers also there. But we are aware about it. But by May 10th, May 14th, we are already back. If you look at May month, May 1 to May 14th, we are at 0.12% new accretion, actually. So it's already come back to normalcy. So it's a question of small blip in the April first half. Otherwise, we are definitely near normal compared to March last year or April last year.
Got it, sir. And sir, last question, more I would say a bit philosophical. In this cycle, what is different versus in the previous cycle, how we look at and analyze this? See, historically, we always used to look at, say, PAR, right? When is the PAR peaking out, how it is trending. Now, in this entire cycle, the conversations, sir, have moved to, say, incremental pace of PAR accretion, right? At the end of the day, the PAR is still keeping on increase. Are we, I would say, trying to, say, crystal gaze too much in future, say, if trends persist like this 12 months down the line, this is what it could look like? Because when we look at X bucket collection efficiency, by definition, sir, after 9 months of pain, it has to improve, right? because we are eliminating the delinquent customers from the base.
Correct. So expected collections need to come below, need to be above 99.5% to reach the near normalcy. That is what we are telling. Largely, many states other than Karnataka, we are more than 99.5 to 99.7% expected collection. So why one using X bucket as a benchmark today? Because the current par in the system is much higher. If you put the par as a control, it's difficult to assess the actual efficiency, because every par of even 0.1% actually increase the total par. So therefore, the X bucket become relevant today. Maybe once this entire journey of provision and write-off is completed, we will be back to a collection efficiency as a norm. So this is currently probably X bucket collection is the more relevant. When this whole journey completes, entire things are written off, then you are normal, and then you look at better ways the collection efficiency or a par zero kind of thing.
Yeah, and new par accretion rate is important for you to get a view of how things are moving.
Trending, yeah.
No, fair enough, sir. I get it. But if we, in the denominator, in an X bucket collection efficiency scenario, keep on removing the delinquent customers, like after 9 months, say, 10%, 15%, or 20% of the delinquent customers, as they keep getting removed from the denominator, the X bucket number will keep improving, right? Because the book has not grown much in this period, right?
Yeah, in this period, it's not prudent to grow the book also, right? We need to be
fair enough. I agree.
Careful.
So my question, sir, was more, I would say, I understand from as a manager how you want to look at it, and probably this is the right metric. But more so from, say, analyzing it, are we kind of trying to jump the gun?
Viral, from analysis point of view, you have all data. You have a collection efficiency, you have par 0, par 60, par 90 plus, you have X bucket, you have all the parameters available to analyze, right?
Right. Fair enough, sir. Thank you.
Thank you. Our next question comes from the line of Ashlesh Sonje from Kotak Securities. Please go ahead. Ashlesh, your line is unmuted. Please proceed with your question.
Can you hear me?
Yes.
Hello.
Yeah. Please.
Okay. Hi, sir. Good evening. Few questions from my side. Firstly, can you share the X bucket collection efficiency number for the months of April and May thus far? I believe we had disclosed a number of about 99.3, 99.4 overall for the month of March. So that is one. Secondly, in your understanding, why are you not so worried about incremental drop-offs after the implementation of the 3-lender cap in April? Because even now about 9% of your loan book is exposed to that set of borrowers. That's the second one. And lastly, more qualitative, when we speak to industry participants, we understand that there is a general challenge of uniquely identifying borrowers because different lenders tend to use different KYC documents. Additionally, it also seems like the credit bureau is not allowed to store or share the Aadhaar number of the borrower. So where are you and where is the industry in general today on solving that issue? Thanks. Those are all the questions.
Yeah, I think, expected collections par 0, we said 99.6 or drop.
No, on the overall book, it is around, say, 99.2 because of Karnataka.
If you exclude
Karnataka, it's around, say, 99.5.
In the month of April, May
it will be better because as you see, Ashlesh, as on 11th of May, we have added around, say, 12 bips of par 0. So if we continue the same trend, maybe for the full month, we add around, say, 25 to 30 bips of par 0, which means that the collection X bucket will be around 99.7.
That is including Karnataka.
Yeah, including Karnataka. So we need to see.
So normally, excluding Karnataka. Correct. That is one. Second is about the dropout and the incremental growth, right? So we know that there will be about 6-7% of customers we have to drop, and the portfolio also to some extent we have to drop almost 7% rate of income. But feel we have a opportunity. If you look at the slide, we talked about guidance. We mentioned what are the challenges and what are the opportunities that we have. We feel we'll be able to acquire customers. If you look at in the Q4, we acquired 2.61 lakh new customers with the 43% new to credit. So
sorry to interrupt you. Hello. So this question was more around worrying about delinquencies because you won't be able to lend to some of these borrowers.
Ashlesh, regarding your question on delinquency, see, largely as we have
understand.
No, his question is that number of lenders where borrowers where we are more lenders. That pool is still there around.
Yeah, it will be that they're paying. No, 80% of them are paying.
Yeah.
So
Ashlesh, as you see the slide on delinquencies, wherein ex-Karnataka, we see that even in case of borrowers with more than 4 lenders, the PAR has largely been stable. So this is something we have been saying earlier also, that the delinquencies have largely played out and not the entire pool having multiple lenders is bad. So there we still have 80% customers who continue to make payments, and over a period of time, normatively, the customers who keep making payments, obviously at some point in time, their one or the other loan gets closed, their overall outstanding falls below 2 lakh and they again become eligible. So this is not going to be a permanent loss for us. It is only a temporary adjustment wherein borrowers will have to wait for some time, get their obligations under control, and they again become eligible. Obviously, during this time, customers who might get into delinquency, they are getting into the delinquent bucket. So that is something we have seen over last 6 months.
Yeah. Also,
some of it will happen.
Also, we need to recognize that these are all short-term loans. That's why it's actually coming down faster. Maybe this month they may not be eligible, 3 months down they may be eligible because they would have paid as the 3 installments to all of them whom they borrowed. I think that's why I said 81% of those customers are all paying in good standard even today. So I think most of them will remain, and by the time they come back for renewal, probably they will be back with eligibility. So therefore, we believe that this is not a big risk for us.
Understood, sir. The question comes because in the last few months, we have seen many lenders starting to disburse as well at a fairly robust momentum. The fear is that, how are we sure that the repayments which are coming through are purely because of recovery in incomes and not purely because of the access to disbursements?
So I see, so long they're paying to all the lenders and when they come back for the renewal, if they're not what you call default with any other lenders and they're within the 3 lenders norm or within 2 lakh, we don't see a risk in renewing, right? That is point 1. Second, fine, maybe some other lender they borrow from somebody else and pay to us, but they are paying to me only one installment, not the entire loan. Correct. And they would have borrowed with no delinquency with anybody and they're eligible to get the money. I don't think there's an issue there also.
Understood, sir. Okay. And sir, the last one on borrower identification.
KYC, sorry. KYC, we have to go by only voter ID at this point of time because of the regulatory requirement. But we actually implemented the entire portal checking long back. So every ID is deduplicated and the portal checking is done. So to large extent, it is
only one impact what we have been observed earlier is the bureau. Sorry, I think we lost.
No, sir, I can hear you. I can hear you.
KYC challenge कैसे?
We are having the KYC challenge. Identification of only for.
इसको बोलो ना please call.
You can hear me? Hello.
So just give me one moment. Ladies and gentlemen, the line for the management seems to have been disconnected. Please stay connected while we reconnect the management back. Ladies and gentlemen, the line for the management has been reconnected. Please go ahead, sir.
Sorry, we had some technical problem. So I was talking about the bureau data, right? So voter ID is being validated through a voter ID portal before acquiring any customer or before giving any loan. And largely, this is stable across industry today. And one of the problems which we had, most of the banks used to give data once in a month. By regulation, it becomes fortnight. That also is a higher frequency, which helps the identification faster. If any multiple lending can be checked faster. And then even the entire regulator, particularly MFIN, is tracking all the MFIN members about the KYC side as well as the multiple lender side as well as the leveraging side also, and then they give back the data if anyone breaches us. So largely there's a good governance there. So therefore there may not be too much of risk coming. Of course, if Aadhaar would have been there, it was very good for everybody. Unfortunately, that is not the case today. So we have to manage this voter ID.
Perfect, sir. Thank you. Yes, yes.
Thank you. The next question comes from the line of Hardik Shah from Goldman Sachs. Please go ahead.
Thank you for the opportunity, sir. Am I audible?
Yes, Hardik. Yeah, Hardik.
Okay. Sir, I have two questions. One is on the growth. Appreciate you calling out group lending growth at 8 to 12% because of potential write-offs. But if you were to think about FY27 in a normalized environment, how should we think about growth? If you could break that down into borrower growth and ticket size growth. Why I ask that particularly is because penetration levels in some of the large states have already reached at very high levels. Bihar, more than 90%, Karnataka, Tamil Nadu, 65%. So what are the states that will drive that borrower growth, if you could allude on that?
I think, our microfinance growth would remain range bound between 8 to 14% even for FY27-28 also, because we already said that our microfinance growth will remain lower, whereas non-microfinance growth will be little higher to compensate that. So therefore, we believe that between 14-15% or 12-14% is feasible in microfinance by through new customers as well as retained customer renewals, which is still possible. So we don't see a risk there. And the geography-wise, I think there are still many large geographies unmet. If you look at the entire India, even the 80% of the MFI covered districts, high districts, still you have more than 30%, 30-40% of unmet demand there. So which we can continue to address that in the deep rural. If you look at our business is deep rural, and it is still there is a high opportunity there. As you see right now, our new to credit is almost 43%, which is basically a new customers, right? So that means there is a huge opportunity still.
Got it, sir. In terms of borrower and ticket size, fair to assume 8 and 4 if you are calling 12% as the group lending? Or is this more going to be only borrower and ticket size kind of remains flat because we've already seen over level?
Actually, because we always work on retaining customers and evolving with them. That means the retained customer will get a higher ticket size. Therefore, there will be two sets of growth. One is growth from the new customer, where the ticket size will be lower for the current year, but by 27 they will get the more. Correct? So it's always a continuous journey. So the growth will come from some percentage come from the ticket size or on a renewal, higher renewal, and then some set of growth come from the what you call the new customers. So 7 to 8% may be our customer growth. Is that about 10 to 15% will be the portfolio growth kind of thing on a range bound kind of thing.
Understood. Very clear, sir. So second question is
microfinance. I'm talking about microfinance only. Others is retail.
Yes, of course. Yeah, am I audible, sir?
Yeah, please.
Yeah, my second question is on the proposed bill by the central government on banning of unauthorized lending act, Pan India, which kind of looks like the reading looks like similar to Karnataka ordinance. So any early view on that, if at all that was to be implemented, how could you navigate that?
We don't have much idea, but actually when Karnataka government was doing this regulation, actually did go through the draft guidelines of OLA actually. I think it's largely aligned with that. So we have to wait and see about it.
Okay. Okay. Thank you, sir.
Thank you. Our next question comes from the line of Bhavesh Kanani from Swan Investments. Please go ahead.
Thank you for taking my question. Just a quick one. Some color on the individual loan composition we are looking at over the next couple of years, and the yield differential between the group loan and individual.
So broadly, we have guided that incrementally the growth in microfinance will slow down and the retail will catch up. And we've guided earlier that roughly around 2028, we will have anywhere between 12 to 15% of non-microfinance. And yields, as we said earlier also, most of the retail finance loans are either equal or slightly lower than microfinance loans, except for home loans, which is today averaging at around 16.9%. So we will take some partnership route for home loans once we have some traction in book size and experience, thereby neutralizing any impact on yields.
Okay. But would you like to call out within this 12 to 15% individual loans, what kind of mix will be contributed by home loans?
So, Bhavesh, overall, the retail finance, what we are looking at, maybe it might reach to 15% of this. So, as of now, in this, the secured versus unsecured is around, unsecured is 75%, secured is 25%. So, maybe over the next couple of years, we aim to take it to around, say, 50-50%. So, in secured book, largely it will be the secured business loans, affordable housing loans, and two-wheeler loans. And unsecured will be the individual business. So maybe it might settle somewhere around 50-50 over the next 2 to 3.
Okay. So in essence, NIM implications, you don't see any major NIM implication because of the mix change?
No. We don't see any major implication on NIM, whereas you will have an advantage of a cost implication, a better cost implication, because this is there is no or a minimal acquisition cost, because that's we are going to do majority of the business with our existing customers. So there's advantage on OpEx.
Bhavesh will try to be neutral at the PBT level. So since on the retail finance, individual business loans, it is all given to our existing customers. And even in the secured book, which is the secured business loans and affordable housing loans, we still have around 60% existing and 40% new. So across a larger portion of the retail finance, we will not have any sourcing cost. So to that extent, our cost structures will be under control, and we will try to optimize our pricing to be competitive in the industry. At the same time, ensure consistency on the PBT front. So that's what we'll try to maintain the ROAs across all the products.
Got it. Thanks for the response.
Thank you. Ladies and gentlemen, we would take that as the last question for today. I now hand the conference over to the management for closing comments.
Thank you, everybody, for patiently listening, and then thank you for questions also. Forward for continuous support. Thank you very much. Good evening.
Thank you. Thank you all.
On behalf of ICICI Securities Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines.